Hey, good morning. Monday morning, it's Carl, and I wanted to do a little teaching on financial concepts today. If you've looked at the markets, the Dow is down 300 or so points, and the digital currency markets are down almost to where they were last year. And so the question becomes, how in the world do you survive the ups and downs of the market? Because invariably it seems like we buy at the wrong time, and that's why we don't buy on emotion. We have to be strategic in what we do. Now, let me preface this by saying I'm not your financial advisor. I'm not a financial advisor. I'm not a tax person. You need to consult your professionals for those things. I'm going to teach you concepts today, but you need to find out if those things are appropriate for you. So I've got a scenario for you here, and it looks like what happens to a lot of people. So I go in and I buy, but I buy at what seems to be the top of the market. Let's come over here. Sorry, I'm looking out the window. I got guys working on my house today. So I buy at the top of the market, and lo and behold, what happens? The market begins to decline on me. So I have a choice. Do I cry because the sky is falling, or do I use smart investment strategy and I keep buying on the downturn? Well, smart investment strategy is you keep buying on the downturn, or in the case of digital currency, this is why you use mining. So you don't really care what's happening with the figures. You're wanting to collect more assets. But let me show you how this works. So I bought high in the market. I bought one of whatever at 1,000, and goodness gracious, the market tanks on me. Next thing I know, it's at 500. Well, instead of just crying about it, what do? I buy again at 500. Or in the case of mining, I've got more digital currency coming in at 500. Well, goodness gracious, the market keeps crashing. Now I'm down to 250. And so if all I was doing was holding, then yeah, I would be in a precarious position, because if I sell out, I'm going to basically take a loss. But what I do is I just trust the markets are going to do their thing. And so I just keep buying at regular intervals. Or in the case of mining, the mining contract is returning digital currency at regular intervals. So the market comes back up, we're buying again, or we're gaining asset again at 300, we're gaining again at 600. So what ends up happening is the total cost of those transactions is 2,650. But if we're using an average, our cost basis is actually 530. So we've not taken a hit with the market. What we've done is we've averaged out the return. We've averaged out the cost basis so that the downturn doesn't eat our lunch. And so the reason I'm sharing this with you is one of the smartest things you can do financially is you just keep making the transaction. You just keep acquiring the asset. You don't get all focused on, well, goodness gracious, it's dropped in half. It's dropped by 75%. Great. That means you're picking it up at a lower price, and you're dropping your cost basis by doing that. So in the case of let's say the markets, if you're doing mutual funds, then you're using what's called a dollar cost averaging strategy, which means every month you're just putting the same amount in month after month. You don't really care if the fund is up or down. What you care about is that you're acquiring more shares, or if you're buying shares of stock, you would do the same thing. In digital currency, what you do is, instead of buying and holding and speculating, you mine. For me, the easiest way to do that is you acquire a mining lease, and that can be done very inexpensively for about $500 to $600 just to get started. And that means every day or so, every couple of days, you've got more of the asset being put into your cryptocurrency wallet. So in the case of the digital mining that I utilize, the payout is in Ethereum, and payout's not the right word. The deposit's Ethereum, and so every day or every couple of days, I've got more Ethereum being put into my digital wallet. So I'm acquiring the asset, I'm acquiring it at different levels, and from a tax standpoint, what that's doing is I'm lowering the cost basis. And so it just simply allows me in a volatile market that's moving up and down to make gains, whereas if I were to simply just buy and I bought at the wrong time, I'd have to hold forever and ever and ever and hope it came back. Well, by averaging, I'm lowering my cost basis, and it becomes easier for me to get into the profit column on that investment. So I hope that makes sense to you. Again, consult your own advisors, your own attorneys, your own tax people. But if you've got questions on dollar cost averaging, if you've got questions on cryptocurrency mining, I'd be happy to direct you to the things that I utilize in my own financial portfolio to ride out the waves of the markets. Again, investing is a long-term strategy. It's not gambling. We're not going to the craps table hoping to hit big. It's a long-term strategy, and if you'll view it that way, you'll come out well. If you try and gamble, you may or may not do well. You may do well one day, and you may get your lunch eaten the next day. So those are my thoughts today. Have a great Monday. Thanks for watching. Thanks for being my friend. Talk to you soon.